All right. Let's get the microphone over here. We are live Monday, 6 p.m. Pacific Standard Time. Thank everybody who has joined already. I popped in here a few minutes ago and we've already got questions flying. So I'm excited to dive into it, whether you're a new loan officer, whether you're a consumer looking to buy a house, whether you're a real estate agent, whether you're just somebody who's interested in real estate and mortgage. Every Monday at 6 p.m. Pacific Standard Time, I jump on live Q&A, answer your questions, give you super honest feedback. Sometimes it's not what you want to hear, but it's the truth. Sometimes I don't know the answer to a question. And so I leave myself a note. And a couple things that I'm going to start doing. One, which I've already talked about, is if I don't know the answer to a question, I'm going to write it down, and I've got it in my digital notepad where I can go from week to week and roll over and say, hey, what was the question from last week that I have the answer to that I didn't know live on the spot, right? Last week, somebody was asking, and I had guessed, if you have a home equity line of credit open, but you haven't drawn on it yet. Home equity line means it's like a line of credit with your home being, there as collateral. So say you go get a home equity line of credit, you've got $100,000 line, but you haven't drawn anything from it, so you don't have any balance due. Will that affect your debt to income ratio? And I said, I don't think it will, but let me confirm. So I just want to let you know, I did confirm it does not affect your DTI. Sometimes in the moment, I've got so much mortgage fog going on in my head that I forget some things that I've learned along the way. So home equity line with no balance drawn will not affect your debt to income ratio, confirmed, but it will affect your loan to value. So if you're doing a refinance and you owe $300,000 and your house is worth $500,000, if you didn't have a home equity line, you'd have a 60% loan to value, and you get pricing based on that. If you have a home equity line that's $100,000, even if you haven't drawn on it, that's going to go into your combined loan to value. It's going to up that number to $400,000 of the $500,000 it's worth. And so your pricing is going to be based on a CLTV, combined loan to value, of 80%. And for those of you that don't know, 80% loan to value versus 60%, the rate is going to be slightly higher. So that's the only one I wrote down from last week. The second thing that I'm going to start implementing is each week when I get updates on any changes in guidelines, anything that might affect you as a borrower, anything that you should know as a new loan originator, I'm going to share that here. And I think I'm going to do it at the very start. And a quick little update to Fannie and Freddie, to DU and LP when you're doing a conventional loan, is the income and assets in the file now just need to be within the last 4 months. The funny part is I saw this update and I was like, did it used to be 3 months? Did it used to be 2 months? Was it 60 days? Was it 90 days? LP, which is Fannie, is 120 days. And DU, which is Freddie? Fannie to Fannie. Fannie is 4 months. Freddie is 120 days. You might think that those are the same thing, but they're different. Trust me. One might be 162 days. And different agencies, different guidelines. But anyway, your income and your assets just have to be, less than 120 days old. One thing that I want to dig into on this one, and I'm probably going to leave myself a note for next month, is that's the Fannie and Freddie guide, but how are the lenders going to treat it? Because sometimes there's overarching rules in mortgage, and they say, hey, here's what we want, when you deliver the loan to us, and they're talking to a lender, and they're talking to the person who's delivering the loan to them, right? And like that guideline doesn't get passed on to the consumer. So I think I'm getting a little long-winded, but just know that I'll follow up on that and make sure that lenders are actually following that guideline of, we might be able to use June and July bank statements for a loan that we close in September, which we always have to get updated stuff. So if it's a little bit more lax of a guideline where it doesn't have to be as fresh as before, That's good. It's good for the consumer, right? All right, cool. Let's jump into some questions. This is the best part of it. You ask questions, I've got answers. If you have an experience with something that somebody's asking, please feel free to jump in the comments and answer. I've had all kinds of folks in the past say, hey, I did that type of loan once, and here was my experience with construction financing. Or you might know some specific program in your state that I don't know about out here in California. So this is a group effort. This is consolidated knowledge here, and we'll all share what we got. Neem H2, thank you for joining. It looks like you were on well before anybody else, just firing off questions. Let me see if I can get some of these answered for you. Hello from Maryland. Hopefully you're still here. Is it true if you pay less than 10% down with conventional, the seller can pay 3% of the purchase price closing costs? The seller can contribute a seller credit of up to 3% towards closing costs. The problem is you probably won't have 3% in closing costs. Let me give you an example. You're buying a house for $300,000 and you get, let's say you're buying a house for $500,000 and the seller's giving you a $15,000 seller credit. That's 3%, right? If prepaying your taxes and insurance, your title fees, your lender fees, if all of that is $8,500 and you've got $15,000 in credit, you cannot use that seller credit towards your down payment. It can only be used for closing costs. And so up to 3% is what the guideline says, but I'm here to tell you that unless it's a smaller loan amount or a smaller purchase price, maybe it's a $200,000 purchase, and then you got $6,000 in credit, then you're probably going to spend it all. But on the larger loan amounts, you probably won't be able to use that full 3%. What is the difference between FHA and conventional loan closing costs? Well, FHA has an upfront mortgage insurance, which is 1.75% of the loan amount. So that's a big one when you're comparing conventional to FHA. A large difference is that 1.75, while it's not necessarily going to come out of pocket for you, if you do a $300,000 loan, man, I must be tired today. 300,000 times 1.75. I wouldn't usually do this on a calculator. 5,250. Man, that's embarrassing for some reason. I usually have that in my head and I just didn't. So, yeah, 5,250 in an upfront mortgage insurance premium. That's one of the differences for where'd that question go? A lot of the other costs are very similar. Title fees will be the same. Lender fees should be the same. Prepaying taxes and insurance should be the same. How is work equity loan and home equity line credit? How does it work? I think that's what you're asking. An equity loan, an equity line of credit. A loan might be a fixed term, like here's $100,000 you owe us these payments over the next 30 years to pay that back. And that's a loan, right? A line of credit is you've got availability for $100,000 in a line of credit. You can draw 10,000, you can pay it back. You can draw 20,000 and pay it back. It's just an open line of credit. That's the difference. This one you gave a specific, which I'd love to answer. Difference between the rate and the APR. The APR is factoring in the costs, right? So when you have a big spread between your interest rate and your APR, it means there's a lot of costs in that loan. And I'm going to show you something just for comparison purposes, because when you have an interest rate of 3.25, like you're showing here, and you've got an APR of 4.468, and that's a big spread, like a 1.25 spread. It means there's a lot of costs built into this loan. And maybe it's justified. It's not necessarily always a bad thing. Maybe you're buying an investment property condo and it's a $110,000 loan. And in general, like smaller loans are more expensive because lenders don't want them. Maybe that's not the right word for it. Lenders have to charge more for smaller loans because they're not making as much money on them. But on your loan estimate, here's a loan estimate. Don't worry, I've got all the information blacked out, so I'm not sharing anyone's specific information. But right here on page 1 is the interest rate, 2.831 on a 30-year fixed. When you scroll down to page 3, you'll find this, which tells you in the first 5 years, how much will you have paid in total, how much will you have paid towards principal, and the APR. Your costs over the loan term expressed as a rate. This is not your interest rate. So this is the cost of the loan, right? Expressed as a rate, 2.894. And as you see, 2.831 is the interest rate and 2.89 is the APR, meaning there's not a lot of costs baked in here. Very little costs. And so the fact that you're telling me you've got a 3.25 rate and a 4.468 means there's a lot of costs. I would figure out what those costs were. I wouldn't necessarily call it bad, but I would lean towards probably bad. Zeta, thanks for joining. Appreciate you being here. Appreciate your support. You're in there on every video, giving feedback, and I appreciate the heck out of it. If anybody else follows the channel, you enjoy the content, you like the videos I'm putting out, do me a favor and throw a little comment on there when new videos come out, because the likes, the comments, all that stuff, it does something to the YouTube algorithm. It puts it in front of more people. If there's a video where you're like, man, this one hits different, this is good, share it with somebody, or at the very least, leave a comment, right? Because it helps me, it helps the YouTube algorithm, it helps the world, and ideally, this information is going to be shared with people who benefit from it, right? Whether that's a loan officer starting out and the information helps them serve more people, whether it's a consumer, it's like, oh, I didn't realize that I could do that and buy a triplex with an FHA loan. Thanks for sharing. Whatever it is, I appreciate you, and I appreciate anytime you share, comment, do anything that helps. All right, Lori. When you get pre-approved, they check your credit. True story. And then when you're in the process of getting the loan, like in escrow, when do they check your credit again? What most lenders do, Lori, is they've checked your credit, they've pre-approved you, they've collected your documents, you're good to go. Now you're in contract. We submit your loan. The lender wants an updated bank statement. The lender wants a letter about why your address changed on your pay stub, whatever it is, right? Then when we get towards the end, the lender verifies your employment, and they also do a soft pull on your credit to make sure you haven't taken out any new credit lines. You haven't financed a boat. You haven't gone out and bought a Lamborghini. Whatever it is, they're going to do that soft pull very near the end of the loan process, just to make sure that the credit profile that they have on file and they approve this loan for hasn't changed. So that's why lenders will tell you, don't go buy a new car. Don't stop making payments on your current credit stuff. Like you don't want any changes to your credit profile while you're in the process. Jason, thanks for joining, man. Thanks for your time. If I get a personal loan to clear up my credit utilization, will that seem as a red flag or negative to the lender? Will they even know? What I think you're saying is a personal loan, like your brother-in-law loans you $5,000 and then you pay down your credit cards to help your credit. They're not going to know, but here's what I found on some files. And this goes with like just seeing a bunch of loans. So you see a lot of stuff. Let's say you go to get pre-approved next month and you like literally just paid off a credit card and it was a $4,800 balance and now it's zero. The lender might, and I say might, lenders don't always catch everything, might say, where did the money come from to pay off that credit card? And I've seen it before. I've seen them have you source where those funds came from to pay off a credit card. If you paid that off right now, your credit improved, you applied for a loan 3 months from now, no lender's ever going to see it. ask about it or any of that. So you'd be fine there. But if it was like a fairly recent thing, they'll see the credit report. And if they see like $13,000 balance in July and then zero, they might ask you, like, how did that get paid off? This is an amazing, amazing question. If I had a gold star to give, I would give a gold star right here. So the question is, does the amount of the down payment on a home purchase affect the DTI that lenders will approve for? Such as 5% down, lenders won't approve a 36 DTI versus someone who puts 20% down. I know exactly what you're asking. And for clarification for everybody, I put in an automated system all the information I have. This person's applying, they're putting 20% down. Their credit report is in the file. Their income that we have is in the file that we input. Everything is in there and it gets submitted. And the automated system spits out approve eligible, or it spits out approve ineligible, or refer with caution. It gives you findings, which is basically an approval or not. If I can't get the automated system to approve it, these automated systems from Fannie and Freddie, I can't submit a conventional loan and expect to be able to close it. The underwriter looks at those findings and says, oh, we can't get an approve eligible. No can do this loan. So the question is somebody who's got the same credit profile and 5% down and a 36% debt to income ratio, the same likelihood to get approved as same person, 20% down. And for clarification, of course, if you put more money down, the DTI is going to change, but I know what your question is. Your question is like the DTI being the same, right? So maybe it's at 5% down, they're buying at 400,000, and at 20% down, they're buying at 470. And in both cases, their debt to income ratio is 36%. The answer is a 100% for sure. Someone who puts 20% down is more likely to get an approval, or likely to get an approval at a higher debt to income ratio. And I'll give you a prime example. I've got somebody right now who came to me. I've talked to 4 lenders. I can't get my loan approved. I don't know why. They thought they could do the loan for me 3 or 4 months ago. They issued me a pre-approval. Now I'm in contract. It's not getting approved. We looked at it, me and my team, and we said, well, it's a 661 credit score and it's 97% loan to value. So it's 3% down. The system takes into account anything that is more or less risk, right? 3% down is a higher risk loan than 20% down to the lender. That's no secret, right? The buyer has 3% in the deal and the lender's got 97. Where in the 20% down, the buyer's got 20% in the deal, the lender's got 80%. So the long-winded answer to your question is yes, bigger down payments are going to get approved at higher debt to income ratios because it's a risk-based model. And the algorithm knows somebody putting 20% down, we might be okay at 43% debt to income ratio. Somebody who's putting down 3%, that might not get an approved eligible. Everything factors in. The credit profile, meaning like, is there collections on the credit report? Is the credit report 800 credit score with no derogatory ever? And the down payment, 3%, 5%, 10%, 20%, those are all going to be different risk factors. And those layered in are going to determine what the system tells us, approve eligible or approve ineligible. So hopefully that answers it. I'm going to answer your other question. I'm going to go back to my buddy Leroy. Going to start reaching out and getting quotes to refi. Happy to help. Yeah, I mean, if you send us an email at matt@mattthemortgageguy.com, where is that? Do I even have that? There it is. matt@mattthemortgageguy.com. We can send you a link to our application, and the application, once you fill it out, will actually kick back and say, thanks for applying with us. Thanks for entrusting us with your loan. Here's what we need. Just as, you wanting to get prepared for that. If you're a W-2 employee, we want 2019 and 2020 W-2s. We want 1 month of pay stubs. We want your mortgage statement, homeowner's insurance, copy of your ID, and that's it. Those 6 things, piece of cake. If you're self-employed, we're going to want a couple years of taxes. If you're an S corp or something like that, we're going to want the full business tax returns and K1s. If you're self-employed in any way, or you own multiple properties where you're getting rental income, in that case, we're also going to want tax returns. If you're outside of California, then I've got a partner lender who's going to take good care of you, and I've got nothing but good feedback from anybody who's been referred over there. That's greatmortgagebroker.com. You fill out 6 quick little questions, and you get a call, text, email within 24 hours. All right, Leroy, why does Rocket or Quicken have lower rates than most of us? When you say most of us, maybe you're talking about retail lenders. Because for sure, as a broker, I've got better rates and cost structure and terms than Rocket or Quicken. When you say lower rates, be careful, because lower rate doesn't always mean better deal. I can show you the rate sheet on a 30-year fixed loan, and I could go down to 1.99% on a 30-year fixed. So that's a pretty low rate, right? But it's probably on the top 10 list of dumb things you could do is pay 6 points to get a 1.99. Pay $24,000 up front for that would be really silly. So what you want to find is not the lowest rate, but the best structured loan. Low cost and low rate. Maybe it's 2.674 with 0 points. Maybe it's 2.875 with $500 in lender credit. I don't know, because it's going to vary based on credit score, type of loan, cash out rate and term, purchase, whatever it is, right? But for sure, you get me a loan estimate from Rocket or Quicken, I'll beat it all day, every day. I'm happy when somebody comes to me and they've talked to Rocket or Quicken, because I go, oh, that's nice. They want to charge you 2 points up front for 2.875. I could do the same deal and not charge you that $8,000. Trust me, the commercials they run and the marketing they do is not free. Super Bowl commercials cost a lot of money. So price-wise, they're not the best, and they're not even close. Sasha, my dude. Yeah, thanks for the good idea. See, this is how I come up with ideas for making videos. Sasha was like, hey, compare a first and second combo with a jumbo loan. It's a great freaking question. I get that all the time. Why don't I make a video? Why didn't I think of that? So I appreciate you asking that. And your follow-up question is, you said there was another scenario, which I'm curious about, when borrowers are buying right around the loan limit but don't have a set down payment. Gosh, I literally recorded that like 5 days ago, and I have no idea what I said or what I was talking about. Maybe we'll circle back to this, because buying right around the loan limit but don't have a set down payment. Yeah. I'm not sure what I was referring to. Maybe it was like some of these deals I've done in some of these high balance areas in California where the loan limit is 822, 375, and maybe you're buying at 900 with 10% down. But, and if you did, you'd have an $810,000 loan. You'd fall within those high balance conforming loan limits. It'd be a great looking loan, but maybe it appraised at 850, and now you've got to bring in a $50,000 difference, and then you've got to bring in the 10% down. That 85,000, so now it's like 135. So now you're stuck in kind of a weird spot where You're coming out of pocket with more than you thought. I don't remember what I was talking about. I'm going to circle back. Maybe somehow we can ruffle my memory. I apologize. It's been a long day. Jen says, Sabino, hello, hello, hello. What is your opinion on being able to count your rent to get a loan? Would it help a lot or not make much of a difference? That's a good question, Zita. And for anybody who's wondering, I made a video. September 18th is a Saturday. Over that weekend, Fannie and Freddie are going to update their underwriting to allow you to use a positive rental history to get approved. And will it make a difference is your question. I hope it does. It's hard to tell because from the horse's mouth, they said that they did a survey of so many thousand denials. And if they would have been able to use the rent history, that 17% of those would have gotten approval. So as an example, maybe somebody's got a 680 credit score. They're putting 5% down. They've got a 42% back end DTI. And, their credit's got a few dings on it, but like nothing major, right? And it's approved ineligible. They just don't have enough credit history. It's got the dings or whatever it is, right? If that person, by adding their positive rental history, now gets approved, that's a win for them. Their own survey said that 17% of these denials would get approved with rent, which is huge because there was probably some of these denials that were 590 credit score, 3% down, like stuff that was nowhere near, right? So adding this rent history, it's not going to make a huge difference in that like everybody's going to qualify now, right? This is literally like on the fence people didn't get an approval because they didn't have enough credit history or because they were on the fence, debt to income ratio and challenge credit, whatnot. So this is something that should help them, but it's not going to be like a blanket, like all of a sudden we've got, no income based loans where, you can do stated income and we're going to have this flood of buyers, right? A few more people are going to get qualified. That's all that's going to change with that. All right, Diana, I bought a house last year. I want to buy another house this year. That's awesome. Do you think I can qualify for another owner-occupied home loan if I rent my home now to just cover the mortgage? You don't have to rent your home now. I had this conversation with somebody who was referred to me through another past client who had a great experience. I'm guessing because they referred their family member, so must have been good. And we had this conversation on departing rental income. And let's just say for your specific scenario, Diana, that your house could rent for $2,000. There's no need to like go live on your mom's couch and rent it for $2,000 now. So you have rental history. You can, when you're departing and when you're qualifying for the next house, use departing residence income, departing rental income, whatever the heck it's called. It would rent for $2,000. That's market rent. The lender is going to use 75% of that. So the lender is going to say, all right, $1,500 goes on your income side. And let's say you make $6,000 a month. You make $6,000 plus you've got $1,500 in rental income, departing residence that you're leaving you're going to rent because you're using 75% of that $2,000. So that $1,500 in rent plus $6,000 gives you $7,500 in income on the income side of the equation. Now you're going to look at your current mortgage. Let's call it $1,375 a month. Plus your new mortgage, the new place you're buying, let's call that new mortgage $2,000 a month. And let's just say you don't have any other debt because you seem like the type of person you don't want any other debt, just mortgage debt, just the good stuff. And $1,375 plus $2,000 is $3,375, $7,500 in income. Ooh, 45%. That's going to be tough. That's a front end ratio of 45%. That ain't going to qualify. Go get a raise. Go get a raise to $7,000 a month. Then it's going to work. Then you've got $7,000 a month plus the $1,500. Now you've got $8,500. Now we're $3,375 divided by $8,500. Now we're 39.7%. That's the front end ratio. No other debt. Now I think you're good. All right, Liberty Returns. A lot more price drop emails here in Utah. I'm seeing them too, and I wouldn't necessarily say that it's like the market is correcting, the market is falling, the prices are coming down. It's just that sellers and a lot of their agents didn't get the memo that we're going up, 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 up. And then it was like, all right, now we got to chill. They didn't get the chill memo. So they just kept going up, up, and up. And they're like, oh, I missed the memo. I was supposed to price it similar to what it was priced in June, not like 10% higher, because we can't just continue to see, 2-3% price appreciation every month. So, yeah, I think that's it. I think in a lot of areas, gosh, not in Sacramento. Sacramento's freaking bonkers where I'm at. Prices continue to go crazy. 50,000, 70,000 above ask continues to not get it done. But in a lot of markets, from people I'm talking to, they're cooling off. They're returning to normal. They're stabilizing. A lot of different words you can use to describe it. They've got pH balance. They're balancing. Do I have to wait until my due date to make the first payment? Or could I do it as soon as I set up my online account? You can do it now. There's no harm in that. And your mortgage servicer will definitely take your payment if it's early. Viquez, buenas noches. ¿Cómo estás? Can I get a loan for vacant buildable lots? 1, how much down payment do I need? 2, after buying the land, say with 25% down, can I get a construction loan? And what do I need to do for that? You can buy vacant land. 1, how much down payment do you need? I believe you're probably looking at 30% plus. I don't necessarily, I don't broker any of that stuff because I'm not an expert in it. So I know here in California, US Bank, they love land loans, and I've always referred my stuff to US Bank, and people have always told me like US Bank is the place to go. So you can do that. Or your follow-up question, can I get a construction loan? And what do I need to do for that? Some of them have, some banks have products, and here's where I'm honest in that brokers for your conventional, your FHA, your VA, for a lot of stuff, for sure, the best option. In my opinion, other brokers might disagree with me on this. There's other type of products where you might be better off somewhere else. And for me personally, someone comes to me with this question in California where I'm at, I'm going to refer you to US Bank for the vacant land loan. And I've got friends at Umpqua who do great construction loans, and they do a construction to permanent product where, you get the construction loan, and, there's phases in which they release the money to you to build the thing. And when you're all done, they reassess it and they change it into a 30-year fix. So it's construction to permanent. And that's what I would do if I was you. That's what I would, recommend to you if you're in California. If you're outside of California, you might not have Umpqua Bank, or there might be another bank you need to find that like specializes in that. But really, for something like that that's very specific, find someone who's qualified and does a lot of them and knows what they're doing. I'm the first to admit when someone comes to me and says, hey, I want to do a rehab loan. There's great rehab loans in the broker space. And I'm happy to find one of the 130 loan officers that work at Answer Home Loans and say, who does construction, or not construction, but rehab loans? Who knows the FHA 203K really well? Who knows, Fannie Mae's renovation product? Refer it to them, because my claim to fame is serving people, no matter if it means business for me and my team or not. And for a lot of stuff, it's like, nope, I do not do a lot of that. Therefore, I refer you to somebody else. Even people are, I really, really want to work with you and your team. You're not going to be best served work with me and my team if we've never done a loan like that, or if we've done 2 in the last 5 years. Somebody who does 2 of those a month knows the product better, knows the loan better, and can serve you at a higher level. So find a pro. That's my best advice. No problem. I appreciate you being here. You were the first one here at 5:22. You were early to class. Got the front row seat. Is it better to refinance or do a loan mod? I had a modification in 2011 and still active. This is a great question and a question I get quite a bit. And I think people know that when they ask me a question that is in regards to forbearance or modification or refinance, you're going to get my honest answer, whether or not it's something that I can do or not. And for clarification, as a mortgage broker, I can do any refinance. I cannot do modifications. I cannot do anything with forbearance. I have nothing to do with the servicing side of loans. But I've got plenty of past clients who call me and say, hey, this is what my servicer is telling me. Should I do this forbearance? Should I do this modification? How does this sound to you? What do you think about this? And I'm happy to answer those questions. There are loan modifications being offered to clients as they exit forbearance, which I think are great for the client. And a loan modification, if it's offered to you and the terms are great terms, take it. Some people are kind of trying to figure out, and they're calling me right now. I'm getting more calls than ever. Should I exit forbearance and then refinance, or should I exit forbearance and enter into a loan modification? And really, it's going to depend on your wants and needs. I know some people are like, oh my gosh, I've got all this home equity. I want to do a cash out refinance. I want to pay off that amount that I had in forbearance. I want to pull 40,000 out because we really need to do some rehab to the house, or I've got this, 40,000 in credit card debt that's at 18% because I was out of work for 4 months, whatever the case is, right? If you have a need for cash out, then a modification is not going to work because modifications are just mods. They're not going to be, a cash out refinance. And if your servicer is saying, hey, listen, you can exit forbearance, you can do a 40-year term, you can do it at 3% interest, we'll lower your interest as well, and it's not going to cost you anything, by all means, do that. But I think it's going to be client specific, scenario specific, and not necessarily a one size fits all. My buddy Sachs Realty, I saw that. Todd, I hope you're well, man. I love watching your stuff. I still get your magazines in the mail. You're doing great stuff out there on the East Coast. So I appreciate you, man. Keep up the good work, dude. I'm gonna keep following and supporting you. I appreciate you popping in here and saying hello. Check out Sachs Realty if you guys want some good. This guy interviews all kinds of people from all over the country on all sorts of topics that relate to real estate and construction and investing and mortgage and all that other stuff. We had a fun interview. Gosh, what was that? Like 5 or 6 months ago, maybe. Keep up the good work. Kevin Quensa TV, on unemployment last year and this year, and now have a job, so no more unemployment. I want a multifamily unit I will live in as a first-time buyer. You can't, and well, you might include it on your application just to say, oh, during this period I got this unemployment. They're not going to be able to include it as income, and that's something that I get quite a bit. I talked to somebody today who is a bartender and said, I was out of work for 18 months. Now I'm back. Can I qualify for a mortgage? If you are a salaried employee and you were out of work for some period of time, now you're back to work full-time, full pay, and it's predictable and it's the same every single month, $6,500, $6,800, you've got a chance of being approved for a mortgage. If you're out of work for 18 months and you had any sort of variable pay, bartender, server, maybe your hourly, construction worker or something of that sorts, I hate to break the news to you. You're not going to be able to get a home loan. And I think that it's tough to hear. I mean, I literally hate those phone calls. On the phone call earlier today, I was like, you can get a co-borrower, you can get a salaried job, where it's like, here's your offer letter. You're going to get $7,000 a month. It's guaranteed. But anybody who's got any sort of variable pay, if you've gotten a home loan before, that I'm going to look at 2000. I say it's, the lender, the underwriter. It's going to look at 2019, 2020, 2021 year to date. And they're going to say, okay, they made 60 grand, then 72 grand. And then year to date, they've made 41,000. We'll take all that. We'll do a, 31 months or however many months that is average. And we're going to be able to give you $5,781 in monthly income based on that average. If you have a humongous gap, 2020 was 14,000 and, 2019 was great because you worked the whole year. And then 2020, I'm back to work and now it's decent again. You're not gonna be able to get a loan. It's just, it's unfortunate. And I know it's tough for some people because it wasn't even your choice. You were out of work, no choice of your own, business shut down or whatever the case was. But unfortunately, that's the truth for anybody who's any sort of variable income. Yeah, no problem, man. I enjoy doing this stuff. Look forward to the email. Shoot us a message. We're happy to help. All right, Neem. Buy lot and build house will be cheaper. How much minimum usually required down payment? And is closing costs same with mortgage? I don't know much about the lot loans on what the terms are with that. But this is probably a misconception for a lot of people. They're like, oh my gosh, houses are crazy. I'm going to go build something. Well, good luck. Expensive. I mean, I don't think I'll offend anybody if I'll say like, it's a rich person's game, doing ground up construction. One, because it's capital intensive. Like you can't do it with 5% down. More often than not, you got to put a hefty down payment on the lot. Most people buy lots cash. And so, I'm looking at neighborhoods that aren't even that nice in California where a lot costs 250 grand. And so you buy the lot for cash or you put 75,000 down, and then the construction loan, they're going to want 20% down. Like it's a high risk endeavor. And I'm not an expert on construction loans, so I probably shouldn't be speaking too much on them. But from what I've seen, it's not going to be the cheaper route. And if it is, it's not by much. And all things considered, it's going to be hefty out of pocket costs, even though you're getting a loan, like a construction type loan. You still got to have quite a bit of skin in the game. If your loan was added to bankruptcy 9 years ago and you qualify to refinance, does that erase your bankruptcy status? No. Your bankruptcy status that, should be falling off your credit very shortly anyway is not going to be affected by you refinancing. And if you, whether it was a chapter 7 or a chapter 13 and that loan was added, you refinancing doesn't change that, that past bankruptcy. I think that answers your question. Hope so. Once you have been submitted to the underwriters for a refi, Fannie Mae loan for 3 of my rental properties, is a competitor mortgage broker going to have to submit all the paperwork again? I think what you're asking is, like, you submit it all to one lender. Does Fannie Mae just have it sitting and you're like, oh, I'm going with this other lender, but you guys got my stuff? The answer is yes. You would have to get it to the new mortgage broker because they're going to have to submit the package totally separate. It's not like it's going to be housed in some like database where Fannie Mae has it. My taxes are complicated, but I'm 780 credit score with plenty of equity. My house is paid for. It seems like it's taken forever and terrible customer service on responding back 3 weeks in. Yeah, I mean, I'd be curious on, are you using some big nationwide lender? Are you using a local mortgage broker? Are you using, yeah, I mean, it's really specific. Like it could be from any channel. It could be a retail, a bank, a credit union, a broker. If the specific person you're working with is not that good, or they like vacation more than they like structuring a business that operates smoothly, maybe maybe it's time to jump ship. But you should be able to within, a business day, get an email response, a phone call back or something to just say, hey, what's going on with my file? Once your file's submitted, most lenders I'm working with are like 2 days max on approvals, at least initial approval, right? To say, hey, we got an approval, but we need these 6 things from you. It's a great question, Leroy. Why does DU say approve ineligible when it's denied? What's the approval part mean? Why not just say ineligible? That's a great question. I've never asked myself that. What's the approve part of the approve ineligible? Maybe because it's like approvable. It just needs to be tweaked. Whereas like, even refer with caution. Sometimes you tweak that and you can get an approval. So approve, I'm writing this down because I'm circling back to this. This is good. Approve eligible. I feel like I knew this at one point in my life. I feel like I knew this in 2014, but I've since forgot. Why? Oh, I got to write the correct notes for myself. Approve ineligible. Why approve? Why not denied? It's a great question. I was going to try to answer it, but I'm really not sure. So that's the better answer. No problem, Diana. Best of luck to you. Buy another house. Just keep buying them, 1 a year. Hey, Fifi, thanks for joining. You got a question on what is the difference between a conventional loan and an FHA loan? So FHA loans are government-backed loans, which in general are more flexible with credit score and, more often used by 1, first-time home buyers, and 2, people with challenged credit. With FHA, you're going to be able to go down to a lower credit score and still get an approval. With FHA, you're going to be able to have more dings on your credit and still be able to get a loan. Whereas conventional is going to be a little bit more strict, right? I mean, more strict on the debt to income ratio. They're going to be more strict on the credit score. For instance, conventional, you can't go below 620. On FHA, some lenders will go all the way down to 500. And with that 500 credit score, you got to put a bigger down payment. But even down to 580 with FHA, you can put 3.5% down. So it really depends. And right now, conventional loans are priced so competitively and such a good product that probably 660 and above or 680 and above credit score, conventional is going to be a better fit. Unless you're right on the brink of qualifying and maybe like you can qualify for 330 FHA and only 300 conventional. But besides those differences, you really want to talk to a broker or a lender who can put the 2 options side by side. Maybe you apply and you've got a 665 credit score and you've got 5% to put down. They can show you the 5% down conventional versus the 3.5% down FHA. See which one makes more sense. FHA has a fixed mortgage insurance that you're going to pay every month. Doesn't matter what your credit score is. It's going to be the same amount regardless of credit score. Whereas conventional, great credit score, small mortgage insurance. Not so great credit score, bigger mortgage insurance. So it's going to fluctuate. So those are some considerations to take when you're looking at those 2 home loans. Both of those loans are used by first-time home buyers. Both of those loans have, conventional has a 3% down. FHA has 3.5% down. And so they both have, fairly low down payment options. And it's just a matter of your specific scenario to determine which one's better for you. All right. You're welcome for the honest advice. You're in California, hit me up. We're happy to help. I'll pop that up real quick. Matt@mattthemortgageguy.com. I've got a long list of people to get back with tonight. Trust me, anybody who sends me an email that needs advice, if my team cannot respond to it, I respond to it. And I hope I don't miss anybody. I'm trying to make sure I get back to everybody. I've got the team basically tasking me so that everybody gets responded to. There you go, Jorge. Let them know. Smash that like button. I don't know how many likes we got, but not enough. I'm not going to look. Whatever we got, I'm grateful for those. If we got any more, I'm grateful for those ones too. You know what, Jorge? This is called what's it called? Like social equity or something? I just give it all away, but trust me, the universe pays me back. I'm too blessed to be stressed, so I'll continue to give it away for free. I think I've had my fair share of generosity poured on me throughout the years. So here's an hour and a half of me giving back every single Monday. I enjoy the heck out of this stuff too. I get to learn something new every Monday. People have all kinds of surprise up their sleeve, and then we get these questions that are just like stuff I didn't even think about. I wouldn't be able to think about this stuff on my own. So I appreciate you. Good evening. Good evening. All right, my buddy Joey. What's up, man? All right, you're getting ready for classes. Yep. You know what? Get ready with that one rental at a time course. My buddy Mike Zuber. If anybody hasn't checked out One Rental at a Time, he's got a YouTube channel. The guy's an absolute machine. I think he puts out like 5 to 7 videos every day. Has me on there on Wednesdays. We usually go over 2 or 3 topics. Has other real estate investors and entrepreneurs and experts that he interviews throughout the week to get their input. He does a daily news every single morning. All kinds of good stuff. I can't say enough good stuff about it. And he's got a great book, One Rental at a Time. Talks about him and his journey. He's got a bunch of rentals in California and, left a W-2 job, has, a bunch of passive income spitting off from rentals and really just a simple kind of guide on how you also can do it. Great community too. He's got a community on Facebook where I'm in there popping in, answering folk questions and whatnot. So shout out to Mike Zuber and that course. Good luck, Joey. Keep doing the work, right? You're welcome. You're welcome. You're welcome. One of these days, we're going to get up to 100 people at once. We're up to about 57. That's pretty good. I like it. I knew if I kept doing it every Monday, we'd eventually, add more people would join. So let's get it up to 100 people. Invite your friends, invite your family. Okay. When getting pre-approved and the bank asks for income, do you look at your paycheck and find gross wages, or you need a pre-approval on AGI? I have insurance, retirement coming out of my paycheck. Gross income is what lenders are looking at. And so if you are in a W-2 job where you get, $6,600 a month in gross, and then you've got insurance and retirement and whatever your other, deductions are before you take home $4,152, $6,600 of what the lender goes off. Some people think that's crazy because you can't spend that $6,600 on the mortgage, but that's how it works. So it's gross income. If you're W-2'd, if you're a self-employed borrower, whole nother bag of worms. Then we're talking about your net. Why that is? Again, I don't make the rules. I just work here. Self-employed, we're going off net income. W-2 borrower going off gross income. All right, Diana, you're back. Your first home is an FHA owner occupied. Then you bought an owner occupied conventional. Is it possible to move back in the first home, but do an owner occupied cash out refinance? Sure. You could do that. The one thing I'll give, because I talked to quite a few people about stuff like this where, life happens, people move. Sometimes it's strategic, right? Like you might be looking at it and saying, I got all this equity in this house. I only owe 174 and it's worth 500. I want to pull some of that equity out to buy something in the future, as long as it's legitimate, right? you're legitimately going to move back in that house. Your intention is to stay there for a year, because what you don't want to do is move back in, do a cash out refinance, and then 45 days later, go buy a new primary with that money you pulled out, because that just looks like mortgage fraud. It smells like mortgage fraud, and it might be treated like mortgage fraud. So move back in, pull the cash out, chill for a year, and then, take that cash and go deploy it on another investment property, a new primary, wherever you want to go. Just don't do anything that might be suspect, because you'll get on the naughty list, and you don't want to be on the naughty list, because then you won't be able to get any conventional loans. I know buyers that have tried tricky shit and got their hand slapped. And so if I send their loan to a lender that says this person cannot get loans, that's not a good thing. Yeah, it's my advice. Sticking to it. All right, Joe, you got your mom watching with you. She's a realtor in Oklahoma. Any words of advice for her? She's primarily working with buyers. I guess it depends on what she's going after. I think that if she's watching with you and she's interested in investing like you are, if I was a real estate agent, I would go all in on learning as much as you possibly can about real estate investing, what makes a good deal, what doesn't, and sing that from mountaintops, because, as a real estate agent in most markets, a dime a dozen. And no offense to any real estate agents, but there's lots of them out there. If you're one that understands investing and investment properties and what makes a good deal, and you could find good deals, you could help investors analyze good deals, that sets you apart, in my opinion. And I will tell you that probably less than 5% of real estate agents truly understand real estate investing. So that's my first piece of advice, Joey, because I think that, some of the stuff that you're learning about real estate investing is probably stuff that, moms is looking at too. And so have moms dive into that. And then you start going to like real estate investing meetups and things like that, where you're looking for deals, you're looking for partners, you're looking for that stuff. She's looking for clients. And, she runs into a client and says, yeah, I'm looking for, duplexes in this area. She goes, oh, I know that area really well. I helped the client buy a triplex right down the street. What's your criteria? Oh, you're looking for, cash on cash returns of 10%. Oh, you're looking for this. And then, she can build the rapport, be the expert, and then go out and find those deals. Some of those deals might be something that, her clients are going to buy. Some of the deals she might run by you, and, you're going to put together, a deal and buy it with hard money and rehab it with a partner, whatever the case may be. Right. Like, that would be one of the things I would do, as a real estate agent. Just spitball in there. Hopefully that's helpful. Yeah. This is a good question. When getting pre-approved, you need to have closing costs seasoned in your bank account like you do for your down payment. When somebody says seasoned, for anybody who doesn't know, you have to have 2 months of bank statements with that money sitting in your account. For example, if you're bringing, if you're putting 10% down on a $300,000 purchase, and that means 30,000 plus closing costs is 37,000-ish. You can't have a June bank statement that has 9,000 in it and then a $30,000 cash deposit in July and be like, I'm ready, let's go. That money is not seasoned. If you can't explain where that $30,000 came from, and especially if it's cash, you just can't use it, then you cannot use those funds as down payment on a house. So with that out of the way, with what seasoning means, you would need it for me to say, yeah, you're pre-approved for 300,000 with 10% down. But what you could do is you could come to me or any other lender and say, hey, I want to get pre-approved. I've got, gift funds coming from grandma. Maybe we circle in grandma and just confirm that gift funds really are coming. We pre-approve you. And it's basically like contingent on you getting those gift funds. You know, you've got 7,000 in your account. We need 37 for the down payment plus closing costs. If grandma said, yeah, I'm willing to do up to 40,000 in a gift, then you're good to go without us actually like seeing it seasoned in your account. I almost spit out my coffee. Oh, anybody who follows anything I put out on social media in California knows that like every day it's like clear to close in 16 business days, clear to close in 19 business days, clear to close in 14 business days. If I ever take 90 days to close a refinance, I will close the front door. I will lock it. I will slap myself across the face. I will go home. I will cry myself to sleep. And then I'll wake up and find another job. It should not take 90 days. If you're working with Freedom Mortgage, if you're working with some of these other big companies with big marketing budgets but no operations team, then run fast. Do not work with a lender that takes 90 days to close a loan. I guess some like old antiquated like banks might take 90 days too. I'm interested to know who's taking 90 days. Put them on the do not call this lender ever list. But share it with us. Save the other 50 people watching, whoever, you know, the 300 or 400 that watch this on replay. Let's save them all the pain and agony. This is a true statement coming up, everybody. The mortgage insurance is suck. I agree. The mortgage insurance is suck. No way around it. The mortgage insurance is kind of a necessary thing, though. You know, putting less than 20% down. It's just something. Cal Financial. Why does that sound familiar? Do I know them? I don't want to put them on blast if I know them. I feel like that's a... Sounds familiar. I don't know. Irvine, California. Need more info. I wonder what it is with your specific loan that's taking so long. Yeah, shoot me a message if you want. Matt@mattthemortgageguy.com, and I'll look into it. Try to help you out. But yeah, 90 days is no bueno. Can you tell me the current rates for conventional 30-year, 250, 20% down, 780 score? Do you think rates will hold for a while? It's volatile lately. Thank you. All right, this is good. We are like an hour and 3 minutes in, and nobody has really talked about rates. So we've broke a record, all-time record for rates, but I know rates are important. I know people want to talk rates. So fine. Talk rates. This Friday through Sunday, I think, is the Fed meeting. What is it? What do they call it? The Jackson Hole, Wyoming is where they're meeting. And so our buddy Jerome Powell is going to be speaking. It could be market moving, but here's what's happened lately is we've got uncertainty. We've got economic uncertainty because we don't know if, you know, various strains of the coronavirus are going to cause businesses to shut back down again. We've got like worldwide instability with what's going on in Afghanistan. That kind of stuff will tend to lead to like, let's not screw with mortgage rates right now. It might have a negative impact. That's just my gut feeling, right? Is that if you're Jerome Powell, if you're in charge of the levers, like turn rates up, turn rates down, leave them alone. If you're in charge of those levers, if things are, Corona's dissipating, there's no, instability in foreign lands. If the market's recovering, all right, let's start to dial them back up. Let's get back to normal. Let's taper our purchase of mortgage-backed securities. Then maybe we'd see rates tick up towards the end of this year. My thought is, like, with all that stuff going on, all that uncertainty, they're going to be like, hold up, let's not do anything just yet. Right. That is my honest opinion on what's happening with that. So let me see. I think I got away. Oh, no. I'm still, don't worry. You haven't lost me yet. I'm a little bit scatterbrained, but I remember the original question. Let's price it up. Let's price up a purchase for $250,000. What market are you in, by the way? You can buy something for $250,000. I'd love to be there. California. Just can't do it. 780 score. Purchase. The borrower name is LB Alexander. What do you think, LB? You think it's about 2.8-ish? That's what I think. That's my guess. Here's something to think about when you're pricing loans and you're thinking about it. Like, you want to look at the rate, the cost for the rate, and the mortgage insurance. In this specific scenario, if you work with a lender who's got access to the lowest mortgage insurance rates in the universe, then that's going to matter. And what I'll tell you is, this specific scenario, 2.85 is the par rate with no points, right? You don't necessarily want to pay points. I could tell you, I can get you a 2.375, or I can get you 2%. You don't want to pay $6,200 up front for a 2.375. You don't want to pay $12,000 up front for a 2%, 30-year fixed. 2.85 probably makes the most sense. 0 points being paid. On top of that, this specific lender, United Wholesale Mortgage, #1 purchase lender in the U.S., they're a big behemoth, $240 billion in mortgages they'll do this year. Guess what you do when you're a behemoth? You negotiate the best mortgage insurance rates in the world. $31.88 is all you're paying in mortgage insurance on this specific scenario. So that's important. That's your price check, LB. 285, $31.88 a month in mortgage insurance. All right, LC. In my job, I have steady opportunities to make more money by taking on more tasks. Will they consider the extra money if they are regular, or do they only do base salary? Great question. Bonus, commission, overtime, anything like this where it's above and beyond your base salary, you can use it for qualifying, but we have to take an average. The best way for me to know what I think your future extra income is going to be is by your past. So if you tell me in 2019, you made $14,000 of this extra money. In 2020, you made $17,000 of this extra money. And year to date, you've made $10,000 of this extra money. I'll take all that, and I can't remember the numbers I said, but let's call it $31,000. And let's divide it by 31 months. Those 24 plus the first 7 of this year. And 31,000 divided by 31 is $1,000 a month. We'll take your base of $5,500 a month plus the $1,000 a month in average of the extra. And that's what we're going to use to qualify you. So pretty straightforward. And that works the same, whether it's commission, bonus, extra, overtime, anything like that. We're going to take an average. Difference in qualifying for conventional mortgage for a first-time home buyer and buying a second home. It's pretty similar. We're looking at credit score. We're looking at debt to income ratio. We're looking at credit profile, and the qualifying for a second home or an investment home or whatever it is, it's all math, just like it is when you buy your first house. You've got income and you've got debt plus your mortgage. And if that debt to income ratio jives and the automated underwriting system says, all right, you coo, then you coo. If you are buying a second home, income plus maybe some rents, if whether the second one's going to be a rental, or whether you're leaving the first one and that's becoming a rental. But take that on the income side. The other side, you've got debts plus mortgage one plus mortgage two. Math equation. Does the DTI jive? If it does, yes answer. If it does not, no answer. So yeah, just math. All right. Co-sign someone else, but if I want to buy a house, as long as I don't make the mortgage payments, can I buy? Am I right? Had this conversation today. This is crazy. I have all these mortgage conversations, and then you guys ask me questions. I'm like, as a matter of fact, I spoke to someone today. Guess that's what I do is I talk to people all day, every day. So most lenders are going to allow you to prove, listen, I'm a co-signer. That's my sister's house. My sister pays that mortgage. Okay, Miss Neem H2, show us some proof. Show us 12 months history of your sister paying the mortgage. Okay, here's 12 months bank statements where you can see $2,124 coming out of her checking account, paying that mortgage. All right, cool. Her mortgage, she pays it. You write a letter of explanation. It's her mortgage, not mine. Most lenders will allow you to omit it in that circumstance. I don't have super chats? I should have super chats. Oh, you know what's crazy, Krayler made? Is I used to have super chats and I used to get super chats. I don't have them on. That would be, you know what's funny is when I was doing lives in the beginning, I was getting super chats and my kids thought I was the coolest dad ever. Super chats on YouTube. I haven't got them lately and I didn't know why. If they're disabled, that would be a bummer. Tell me how to enable those. Oh my gosh. Settings. Oh my gosh. VQuez was trying to as well. I wonder why super chats are disabled. I had them on before. Huh. Supers. You're eligible for super thanks. Why aren't they on? What? Man, I just thought you guys didn't like me. All right. I'm only going to give this like 2 more minutes to try to figure it out. But this is funny. Everyone's like, what's a super chat? What's a super chat? Basically, you can tip the person who's doing the live stream. So really big time, cool YouTubers that are much cooler than me will get people like sending them tips, right? And in the future, if I've got 200 people watching this thing and I've got questions flying at me from all directions, sometimes a super chat's the way to be like, look at my question, answer mine, please. Right now, to be honest, I'm a small timer, and so I answer everyone's question. I don't miss a single one. But I still appreciate the heck out of super chats, and I really turn on and manage super chats. Once you've completed all the instructions, super thanks. Man, I could have been retired already, you guys. Let me see if I can find it. I won't belabor this too long. I'll actually add value. versus just YouTube Studio. That look when Matt is missing out on donations. Supers. Oh, super chat, super stickers, super thanks. I just toggled them all on. I'm an idiot. All right. Thanks for pointing that out, dude. I can't believe that when would I toggle those off? When would somebody be like, no, you can't tip me? I don't know. Anyhow, they're now on. Where do we leave off? Here's the simple answer, Stephen. I don't want to get over my own head or over anyone else's head, but when they buy mortgage-backed securities, they keep mortgage rates low. If they stop buying mortgage-backed securities, then the yield has to go up for outsiders to buy it, and it forces rates up, right? And so the government is literally buying like $100 billion a month in mortgage-backed securities. When they turn that spigot off and they stop buying mortgage-backed securities, rest assured rates will go up. But like I said earlier, they may not do that. It might just be like, who knows how long, right? It could be a long time before we see rates go up. I mean, who knows? I was saying rates were going to go up by the end of the year. The more stuff I've seen and the more uncertainty I see and feel worldwide, even just the US with coronavirus and uncertainty with that, like I just lean more towards like rates might stay lower for longer than we think. And I was singing a different tune earlier in the year, but I reserve the right to change my mind sometimes. Just got him, Kraler. Did that for you, bro. Super chats are enabled. I hope so. Someone shoot me 99 cents just so we can confirm that they're enabled. I think I toggled them. I think they're good. Yeah, and when I went into super chats and saw the past where it shows me like what was done in the future, Kraler made, you might have been the first one because it's showing you at the very top. A $5 super chat from you was like one of the first. I appreciate the heck out of that, man. I'm going to go to your channel and I'm going to go buy you a coffee. Kraler made. Got to leave myself a note so I don't forget. I'm getting old. Samit, thanks for joining. Appreciate you being here. What's the requirement for a VA purchase? California, 95% down. Score 763, value 490. What exactly do you mean? What's the requirement? And I'm guessing you mean 5% down, 95% loan to value. It's gonna be a sweet looking loan. 760 credit score in VA. It's probably in the low twos on a 30-year fixed. That look. LC, I've got a great video I made, banks versus brokers or something like that. Or should I use a bank or a broker? As a broker, I'm probably biased, but I can tell you it's not even my opinion. It's fact. Brokers are faster, easier, and cheaper, especially when you put a side-by-side with a big bank. I mean, Chase and B of A and Wells might be good at some stuff. Mortgage is not one of them. There's some rare circumstances where if you've got $5 million in the bank, they're going to give you a sweet deal on a mortgage because they want to retain you as like a portfolio client. But like you're getting a conventional loan for $374,000, they're not good. Their pricing's not good. Their service isn't good. And their speed is horrendous. All right, Leroy, it should be on. Check it out for me. See if we're enabled. All right, Miss Taylor. Thanks for joining. I'd love to hear your take on buying out PMI. I know you prefer paying points for a better rate. Any videos on the pros and cons of buying out PMI? I don't think I've done a video like that. Buying out PMI. I'll make a video. Usually it doesn't make a lot of sense. More often than not, like the amount you'll pay is going to outweigh the 2, 3, 5 years of mortgage insurance you'll pay. For example, if you're going to pay mortgage insurance $100 a month for 3 years, and then you're going to be able to refinance out of it, or something, some event is going to, cause you to sell, or, it falls off because you've made extra payments and it's just that point in the amortization schedule. If you pay $6,000 up front and you only saved, what would have been $3,600 in 3 years worth of $100 mortgage insurance payments, then it's not worthwhile. But I'll dig into it and really use some specific numbers to show maybe where it will make sense and won't make sense. Video coming by end of next week, Miss Taylor. I got you. Oh, there we go. Bam. Leroy, I appreciate you. We are back. We've got super stickers. We've got super chats. We've got it all. Jorge, I appreciate you, man. So I honestly don't remember how it is on this side. I know I've done it. There should be I can't remember how it looks on the other end for super chats and super stickers, but you click on it, and as long as you're connected somehow with a payment form, you can hit that money sign next to chat and do the super chat. Not necessary, but I appreciate the heck out of it. If anybody wants to rock the super chat. All right. Notes are the best. Investment loans. How many mortgage loans can a person have in their personal name? So the limit for Fannie and Freddie for conventional loans is 10. And, if you have 10 loans and you go out and buy a new primary, you can do that. So you'd have 11 in that case, but that's the general consensus. Some lenders, we talked about big banks earlier. Big banks are limiting some to 4. They just are more risk averse. Risk averse means not wanting to take risks. More risk averse, less risk averse. Risk averse. Averse means against, right? All right. Mortgage expert, English language rookie. Yeah, I would, say 10. All right. Sorry about that. I think I might've seen that above and I skipped over it. I apologize, but here's what you want to do, Elsie. You want to go to greatmortgagebroker.com. You'll fill out name, email, what state are you trying to look for a loan in? It's only 6 questions. It's really quick. Somebody from U Mortgage will reach out to you within 24 hours. I promise you, they will give you great service. We had feedback last Monday on the live where people said, "Oh, thank you so much. Just closed my deal with U Mortgage. They're great." They're basically being forced to do right by anybody I send them because people like and trust me to send them to somebody who's going to take care of them. And so I refer them a bunch of business, and they better do right by you, and they will. Oh my gosh, Jason Hibbert. Look at that super sticker. Ba-bam. I appreciate you, man. 10 spot. Very, very kind to you. I appreciate it. I'm glad I got those turned on. I'm glad you said something, Kraler made. I appreciate you, man. Didn't have to do that. But I do appreciate it. This is kind of cool. When you go into my history of the super chats, it'll tell me what video it was on, what comment they made. YouTube is so freaking cool in so many ways. Yeah, I appreciate you guys. I do. And this stuff is fun with or without the super stickers every Monday at 6 p.m. Now that I got them on, Like it's game on, right? All right. Raphael, thank you for the super sticker. I appreciate it. Is it possible to remove a cosigner from the loan without refinancing? Unfortunately, you can't. And this is common, right? This is common when, mom or dad cosign, your sister cosigns. Unfortunately, people go through divorce and it's like, we want to remove the husband or we want to remove the wife because one of the two is going to stay in the house. There is no way to remove somebody from the loan without refinancing. You have to refinance, qualify for the new mortgage in whoever's going to stay on the mortgage. And there's really no other way to do it. There's no way around it. It's something that, comes up quite a bit. If it's, during a divorce or something like that, sometimes it's even like mandated by the court within, a certain number of years or as soon as possible. She's got to refinance him off and get him off the mortgage because she's going to keep the house. She's obligated to pay the payment. And I work a lot around that where it might be, it might turn into an issue because you're gambling with somebody's credit, right? You go through a divorce. She's got the house. She's got the mortgage payment. If she doesn't pay, it's going to affect the husband's credit. And so, I get that a lot where somebody reaches out to me and, is trying to figure out how to refinance and get somebody off. So, it's not possible. Sorry, Raphael. Wish I had a better answer. Jorge, you are exactly correct. Super chat. Much appreciated. All the tips. Love you guys and appreciate them. The like button is free. It's like a free way of showing your love and your support. So do that. Do that there. All right. For a first-time home buyer of 5% down and 740 credit score, what range of DTI is appropriate? By appropriate, you mean how can I get approved? And I want to explain this in a little bit of detail because I think it'll help people out. When we talk about debt to income, we have to think about both numbers. There's a front end ratio and there's a back end ratio. The front end ratio is just your mortgage versus your income. And if just the mortgage is $1,500 and your income is $5,000, that $1,500 of the $5,000 is 30%. That's your front end ratio. Now let's say you have a car payment, some student loans, some credit cards, and all that stuff combined is $700. Now you've got $1,500 payment, $700 in debt, $2,200 total. That $2,200 versus your $5,000 in income is 44%. That's your back end ratio. Front end 30, just the mortgage. Back end 44, mortgage plus all debts. 30 over 44, you're gonna get approved with 5% down and 740 credit score. More, I'm fairly certain, right? You might have some tweaks on your credit report and like there might be a one-off scenario. Maybe it doesn't approve for some crazy reason, but in general, you're going to, when you ask like what range of DTI is appropriate, I would try to keep front end at 36 or below and back end at 44 and below. Doesn't mean that you can't get an approval at 39, 44.9. Conventional is getting a little bit stricter. A 5% down, I would say above 45 on the back end, you're going to have trouble. But keep the front to 36, keep the back to 43. Like we talked about earlier in this live Q&A, with other factors, that can change. If you've got a 660 credit score, that same 36 over 43 might not work. And I'm telling you, it probably won't. The algorithm has gotten more strict. Whether people like it or not, whether you've seen it or not in your business, if you're doing mortgage, is here. It's a little bit stricter. So, yeah. And I think, I know it's hard. It's easier said than done, but when I talk to buyers, like be conservative with what you're trying to buy. If you are able to buy a home where your front end ratio is 25 and your back end is 34, that is going to be a lower stress level transaction and life than if you're like, what's the very max I qualify for? Can I get all the bells and whistles? I mean, that's just not something that I recommend. It's not something that I personally live by. I live in the same neighborhood I grew up in. Could I qualify for a bigger, nicer house? Yes. Would a bigger mortgage cause more stress? Probably. And so, I try to practice what I preach, and I try to eat my own dog food. I'm not going out there buying a $2 million house just because I'd qualify for it. And I don't advise anybody does that either. I think that I advise to the contrary more often than not, where somebody's like, what's the max I qualify for? And I go, well, you told me you were looking at stuff for 550, 600 and you're well qualified there. I could tell you the number is 850, but does that matter? Like if you're content and you can find something in a nice neighborhood that suits you and your needs, buy between 550 and 600. I mean, that was your target. Just because you qualify for 850, the mistake some people might make is then you go look at the stuff at 850. You're like, ooh, that's nice. You start walking through there and getting googly eyed, and all of a sudden you're in contract very top of your price range. And, some agents who get paid more based on the bigger house might say, you know what, you deserve it. Do you, boo? Go buy that 850 house because their commission just went up by, 3% times 200,000. They just got a $6,000 raise for showing you houses. I don't know. Just my 2 cents. We're at an hour and a half. I've still got a video to record for tomorrow. Here's what it's going to be. Why I'm still bullish on the housing market. So look for that one tomorrow. What time do I put them out on Tuesdays? 1 o'clock or something? I'm going to record that thing real quick. I'm going to respond to a couple emails. Get my happy ass home. Mondays are long, but they're worth it. I appreciate the heck out of everyone who joined. Please join me next week. Bring your friends. Bring your super chats. Those are much appreciated. Really, really, I honestly appreciate the heck out of, everybody who joins, everybody who likes it, everybody who shares it, everybody who comments on my videos week in and week out. I really, really enjoy the interaction more than anything. I learn from these just like you learn from them. What was my notes? Approve, ineligible. That was a good question. There was a lot of good questions tonight. I'm gonna get an answer to that. I'm gonna go start with that next week. I'm gonna start with any sort of guideline updates that I think are applicable, and that's going to be going forward every Monday. Start with answering the previous questions, previous week's questions that I didn't answer. Start with any guideline updates that I think are applicable. If you guys have any other ideas with something that will bring you value, please let me know. I'm happy to do that. That's the whole point of this, is bring folks value. I appreciate the community. I appreciate all the referrals. I appreciate everybody that, pops me an email that says, thanks, quick question on this or whatever the heck it is. Yeah, that's enough. Thanks for the night. You guys have a great night. Until next time. Bye-bye.